There's a lot of misinformation out there, and I want you to have the truth. We're going to talk about the real reason that interest rates are rising today on Major Money Matters. Welcome to Major Money Matters. If it's your first time joining us, my name is Major, and this channel is dedicated to giving you information from the economic world and information on mortgages and things that affect the mortgage space. Today, we want to talk about something that's very important because a lot of people are wondering why interest rates are rising, and there's a lot of misinformation. Now, some people will tell you that interest rates are rising because the Federal Reserve raised the interest rate, or what's called the Fed funds rate. Before we go any further, pause here, hit the like button, hit subscribe so you get an update when we post new videos. But back to the Fed funds rate. So the Fed funds rate got raised by the Federal Reserve last week as of the recording of this video. Now, I want you to have the right information because some people will say that interest rates are rising because the Fed raised the rates. Let's talk about that for a second. The Federal Reserve does not have a direct impact on mortgage rates. Okay? The Federal Reserve has no direct impact on mortgage rates. Picture this. Let's take a look at this chart. And this chart illustrates the federal funds rate and the interest rate, as well as the 5/1 ARM and the prime rate. Okay, but for the purposes of this explanation, we're just going to take a look at the Fed funds rate as well as the 30-year Fannie Mae rate, which is the blue line and the red line. You see around March of 2020, you see the Fed cut the Fed funds rate to 0. Now, if you look at the blue line in that same time frame, while the Fed funds rate has stayed at 0, you see that blue line rates went down and then went up and then went up very sharply at the beginning of this year, at the beginning of 2022. So all the time where the Fed funds rate stayed at 0, the interest rates actually fluctuated a bit to its low, to its all-time low during COVID, and then interest rates still started to go up. So this shows you that the Fed funds rate has no direct relationship on interest rates. While there may be other economic factors that are going on that may be a reason for the Fed funds rate cutting the rate to 0, while mortgage interest rates fluctuate along the same time. Conversely, let's take a look at the Federal Reserve's actions in about June of 2019. You see the Fed funds rate begins to reduce or step down interest rates at that time in an effort to stimulate the economy because we were trending already into a recession prior to COVID. And you see, just because the Federal Reserve dropped that Fed funds rate does not mean that the 30-year fixed rate actually moved lower. It kind of just stayed in the same range, although the Federal Reserve dropped the Fed funds rate during that time in July of 2019 to about February of 2020 when COVID first hit. Now, the Fed increases interest rates to hedge against inflation. The Fed decreases interest rates to attempt to stimulate or inject more money into the economy. Now, I'm sharing this with you so you don't become a victim to taglines that people will say to you. Some people will say to you, hey, you need to buy a house before the Fed increases interest rates again. Well, as of news from the Federal Reserve, they have said that they intend to increase the Fed funds rate 7 times this year in 2022. What most people don't realize is that the market tends to react favorably to the Fed increasing the federal funds rate. Here is why. If you are buying a bond, okay, and you want long-term growth on your bond or long-term returns on your bond, then you are going to expect a certain rate of return. If inflation starts ticking up, then you are going to require a higher rate of return on your bonds. Therefore, if you're an investor in bonds, you require a higher rate of return, which means a higher rate of return that's being required by mortgage-backed securities, which is a higher rate that you're being charged as a consumer on your mortgage, because your mortgage is typically a 15-year fixed note or a 30-year fixed note, and investors are requiring a higher rate of return. But as we look around us, we see, inflation all around us. We see higher gas prices. We see higher prices on goods and services. So we see all of these things going on. Therefore, investors are requiring a higher rate of return on longer-termed bonds. So when you hear someone say, hey, you need to buy a house before the Fed raises rates again, the Fed raising rates is actually good for mortgage bonds because the investors feel like the Fed is doing something to get ahead of inflation. The problem that we're having right now is the Fed is offloading bonds off of their balance sheet. Now, depending on whether you believe what the Fed is actually saying or whether you look at the documentation, the Fed is holding about $9 trillion in bonds right now. So they have said that we're going to start offloading our balance sheet. What does this mean? They have all of these bonds and they're going to flood the bond market with treasuries, with mortgage-backed securities, with these bonds that they bought during the COVID period in order to keep mortgage bond prices high and interest rates low. There is an inverse relationship between mortgage-backed securities and the rate and the price at which they're sold at and interest rates on mortgages. So the higher the bond price for mortgage-backed securities, the lower interest rates. The lower the bond price on mortgage-backed securities, the higher interest rates. So basically the Fed is saying, hey, we're going to flood the market with all of these mortgage-backed securities, and buyers of bonds have said, well, it's going to be an excess supply, then I'm not going to pay a very high price for them because I can get them cheaper later. Let's say that you want to buy a Honda Accord, but in a few months, you know that there's a flood of Honda Accords that's going to come on the market. You would not buy a Honda Accord now because when the flood of Honda Accords hits the market, then you're going to have much more options and people are going to have to drop their prices on Honda Accords because there is such a greater supply on Honda Accords. Conversely, if you own a Honda Accord and you're trying to sell it, you're going to try to sell it now, but there may be less buyers because everybody knows that these Honda Accords are going to come on the market in a month or two. So you're going to have to really drop the price at which you sell your Honda Accord in order to get it off of your hands. That's the same way with mortgage-backed securities. You're seeing higher interest rates because of inflation and because investors are requiring a larger return on their long-term securities. So you are having to pay a higher interest rate on your mortgages. And that's simply the way that the system works. So the question becomes, should you buy a house? While the Fed is talking about increasing rates in this environment, what should you be doing in this environment where rates are going higher? I tell you my personal opinion. My personal opinion is that the appreciation of homes is still going up, although interest rates are going up. Being at a home is certainly a hedge against inflation. It is impossible that you would buy goods and services at a higher amount and home prices not be at a higher amount. If you're paying more for eggs and milk and bread at the grocery store, you are certainly going to pay more for a house. And that's simply the environment that we're in. So my recommendation in this environment would be to get into a home so that you ride the appreciation wave and you build wealth. There are some people building and some astounding wealth right now in home ownership. So my opinion is that you should be in a home, and then if rates come back down or when rates come back down, it is a cycle. Interest rates go up, interest rates go down. You deal with the market as it is at the time. But when interest rates come back down, then you have opportunity to refinance your home and drop your monthly payment at that time. But by that time, you've already gained appreciation in your home. So don't fall for the lie. Don't fall for the lie of, hey, the Fed's going to increase rates. That means that that interest rates are going to be higher for the rest of the year. That's not why. The reason is simply because of inflation, and the Fed's trying to get a hold of it. But the reason you see rates continue to rise is because the Fed probably is not doing enough fast enough to combat inflation, because they're concerned that if they do too much too fast, they put us into a recession. We're going to talk about that in a later video. That's it for this time. See you next time on Major Money Matters.